Welcome to Trader TV Fixed Income, your insight into the trading climate for professional corporate bond investors. I'm Dan Barnes. Automation has long promised to reduce the cost of trading, but bond markets are a challenge. In January's show, Juan Landazabal, Global Head of Trading at asset manager GAM, and Gareth Coltman, Head of European Product at MarketAxess, will be discussing when and where traders can use automation to optimize corporate trading on behalf of investors. Juan, welcome to Trader TV.
Thanks, Dan. It's great to be here.
So can you tell us, why are the credit markets less automated than other instrument classes?
To me, it boils down to concentrated liquidity. What concentrated liquidity gives you is certainty of pricing,
okay,
and certainty of execution, or more often than not. And that is something that is not that readily available in the credit markets.
Yes.
So, I mean, if we compare to the US Treasury market, for example, and just take an index, a Treasury index, there's about 8 trillion in terms of volume outstanding versus 5 trillion for the US IG. Mm-hmm. But we obviously have one issuer in the US Treasury market versus around 800 odd issuers in the US IG market. And then in terms of number of bonds, we're talking about 300 versus close to 8,000. That'll give you a sense of that lack of concentrated liquidity.
It does.
And if I can expand that further, so the second aspect that gives you is that you have idiosyncratic risk. So I'm now talking number of issuers, but also number of instruments as well. That means that hedging becomes much harder. And so from a market maker perspective, it's much harder to provide liquidity because you can't offset that risk.
And in which parts of the corporate bond market spectrum do you see automation?
First of all, let's make the distinction between electronic trading and automation.
Okay.
So, because there's been a big uptick in electronic trading in credit markets. However, in terms of automation, that process has been very slow. How I define automation is, shall we say, hands-free trading, where you just send the trade, auto-route it to a venue, and it comes back with the order filled. Having said that, we do have some automation, and it is evolving. Mm-hmm. I would say that this has started out mainly with the US IG market.
Okay.
If we take the sell side, it's only fairly recently that I would say a handful of banks are fully automated from a market making perspective. Mm-hmm. On US IG, but it's not the whole market. It's a subsector of that market. Yep. And also in small sizes, 500,000 to 1 million. And it started in the US because obviously Trace provides a decent level of transparency and also the depth of that market. Slowly moving to Europe. Mm-hmm. Some of them are rolling out those algos or similar algos, adapting to the European market from the sell side perspective. Mm-hmm. On the buy side, it's been much slower take up, much harder. We've been dependent on trading platforms to develop certain tools that would help us automate good composite pricing and liquidity scores, which would give a trader a sense of, okay, well, this has a high liquidity score, therefore I have higher certainty of pricing on that and of execution and so on. Those are the type of tools which have slowly been rolled out by some platforms and which are being taken up by the buy side as well.
So in which parts of the trade life cycle can be automated?
There's a lot of scope. For example, auto routing from your OMS, staging directly onto platforms. You could go one further, as we've just discussed, and have those platforms do the auto execution, and therefore you have from order origination pretty much to affirmation, confirmation. I think the key for me is how to automate the high touch trades. And for me, that's all about data. Now, there's many components which already exist within one's own infrastructure, within a firm's infrastructure. For example, your hit ratios with particular counterparties, You might be getting feeds directly from of Axess into your order management system or onto some other platform.
Yep.
So that's one component. The second component really is the calibration of what the fair risk transfer pricing. That requires correlation matrices, volatility assumptions as well, and a sense of historical pricing and for big trades as well.
To bring that in then, what does a buy-side desk need to do?
To work either with certain platforms or more often than not, as is the case today, to bringing the different components and string them together.
Okay.
So ideally, and we're not too far away, but ideally from a buy-side perspective, for a large non-liquid trade, as it hits your blotter, you would have a tool or pop-up or an engine you can put your trade through that would narrow down the suggestion of counterparties, again based on axes and historical experience as well, and also suggest a risk transfer price to meet or beat.
The automation, does that play to the efficiency of the trading desk, or does it actually have a direct impact on the returns the funds can generate?
No, I do believe that it helps the returns of the fund. The more you can give time back to traders to focus on the harder trades, or support traders with the harder trades in terms of pre-trade due diligence tools, that would lead to better execution at the end of the day, and hence would help the investment process. And look, if the trader has half a day left not doing anything because everything's so efficient, well, hopefully that time's invested again in talking to the PMs, understanding what they need, what are they thinking, what to go out to the market to look for, and again engaging with counterparties and so on. To become more of that sector expert and contribute to that investment process.
That's great. Juan, thank you very much.
Thanks very much, Dan. It's been a pleasure being here.
Now, Gareth Coltman, Head of European Product at MarketAxess, is going to give us his insight into how traders can deliver better results for investors. Gareth, welcome to Trader TV.
Thanks, Dan. Pleasure to be here.
What are asset managers trying to achieve by automating the bond trading process?
So fundamentally, asset managers are looking to reduce cost and increase efficiency on the trading desk. It's very challenging market conditions at the moment, a very, very competitive environment for them, as they're looking for ways to automate manual processes and free up their traders to focus on the higher value trades.
And how evolved is automation in the trading space?
So automation, particularly inside credit trading, is very emergent at the moment. We've seen automation in a number of other fixed income areas for a number of years, for example, government bond trading. But one of the challenges in terms of automating credit trading particularly has been the lack of an available reference price.
Okay.
So in other markets, we've seen this available, for example, in equities where there's a best bid and offer in the order book. But the lack of a kind of centralized order book inside fixed income means that the clients have had to find other ways to fill this gap.
Whereabouts in trading is automation most effective right now?
So we're seeing clients experiment with automation in a number of different product areas. So we have clients using automation, for example, inside US high grade, European credit, but actually also in emerging markets and some clients in high yield as well. Typically, clients are more likely to use automation on the more investment grade end of the credit spectrum, and typically in the more liquid products and in smaller size today.
How has regulation either hindered or helped the automation of trading?
So recent regulation like MiFID II has really accelerated the electronification of credit markets, and I think automation is really an inevitable consequence of that electronification. The increasing transparency has obviously created a lot more availability of data, and that's really helped to drive the demand for automation inside credit trading at the moment.
What tools do trading desks need in order to evolve automation within their firm?
So what we're seeing with the clients that we're working with is they'll initially set up their automation capability, embed their rule set and best execution policy into that automation, and start off with a relatively low bar in terms of what they're trying to automate. For example, very liquid or smaller size. And then as they move forward, what they're looking for is feedback in the form of a kind of best execution analysis, which they can then use to look at the performance of automation and to increase those levels for larger size tickets, more liquid credit. And that's my expectation as we move forward over the next 12 months, is we're going to see clients trying to push the boundaries in terms of what they're doing around automation.
Okay. Do you see any particular types of funds automating their trading process more than others?
Sure, so automation is probably most suitable for those funds who generate a large amount of smaller sized orders.
Right.
For example, firms which have passive strategies, or firms which look after a lot of private wealth individuals, for example. But we are actually seeing take-up of automation across the board in all types of asset manager, where they're finding that even if they're not using automation every single day, where they have a significant increase in the flow that's going through the desk, for example, inflow or a rebalance, then automation is available to help them at those times.
Finally, when clients are looking to a corporate bond trading platform, what sort of questions should they be asking of that platform?
So I think when I talk to clients, they're really focused on three things. And the first one of those is really about access to liquidity. It's very important that through automation, they get the same access that they could get on a manual basis. So for example, if their best execution policy allows them to look at all-to-all trading opportunities on a manual basis, they'd want to find a provider that could allow them to embed that on an automated basis as well. And the second thing is really about data. They're going to be looking for providers who can provide them with reference pricing, in addition liquidity score information, for example. And the third thing is really tools to allow them to monitor and manage their automation in real time as it's going on. So for example, to be able to see in-flight inquiries, see what the automation system is doing, look inside the machine, so to speak.
That's been great. Gareth, thank you very much.
Thanks very much, Dan.
I'd like to thank Juan Landazabal of GAM and Gareth Coltman of MarketAxess for their insights into automating corporate bond markets, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.com.